Well, good evening, everyone. It's always fun to follow after Ty. If any of you have ever been in a meeting with both of us and been fortunate enough to see me squirm when Ty says midway through, hey, I've got somewhere to be. You're gonna finish off. You're gonna get a chance to see me squirm tonight. So it's always good to see so many of you tonight. It's great to see all of you tonight. One of the great things about being part of a growing business is that we get to work with wonderful people like you every day. And nothing highlights this more than events like this. One of the downsides, however, is that it becomes harder and harder to meet everyone personally. So I'm glad we have these evenings to gather together as a family and meet and greet. Hopefully, if we haven't already done so, we'll have the opportunity at some point in the evening to meet you in person and have a chance to catch up. For those of you who don't know me, my name's Will Wang. Some of you may recognize me from my recent famous production and award-winning film on the website called Welcome to HFG Stakeholder Summit. I actually have a short little clip here just to remind you for those that didn't get a chance to see it. And this is not supposed to have audio because I don't like my voice, so I'm actually glad that it doesn't have it. I actually also brought some professional face shots with me today, so if anyone wants autographs afterwards, I'll be sitting right at that table up front. I'm just kidding. No one actually would ever want my autograph. I don't know what that feels like, Vitaliy, so. Okay, well, back to being serious. Tonight I have the privilege to introduce our last speaker, Vitaliy Katsenelson. HFG has never invited an outside guest to speak on the subject of portfolio management, so naturally many of you might be wondering, why do we choose Vitaliy? Well, that's a great question. Since 2008, we have been on a mission to expand our knowledge of the financial markets with the sole intention to provide a better service for our clients. We have been following Vitaliy's work for 2 years. Last year, curious to know what further knowledge Vitaliy had to offer, Ty picked up the phone to call him. What was to pursue shortly after was a strong relationship. And it started from a common thread. That common thread and that passion was for value investing. From Ty's presentation, you can see that our focus is on understanding the macro investment climate at the asset class level. And by asset class level, you might hear us refer to the stock market as a whole. Often, we rarely talk about the micro aspect of investing or getting into the individual stocks. Tonight, you will hear Vitaliy touch on the state of our financial markets through the eyes as an individual securities manager. Vitaliy is the Chief Investment Officer at Investment Management Associates, a value-oriented management firm in Denver, Colorado. He earned his undergraduate and postgraduate degrees in finance at the University of Colorado and completed his Chartered Financial Analyst credential, or CFA for those that have heard of it, in September of 2000. Vitaliy also has an extensive professional resume, which includes publications in the Financial Times, Business Week, and New York Post, as well as 2 published books titled The Little Book of Sideways Markets, which hopefully everyone here has a signed copy of, and Active Value Investing. He and his lovely wife, Rachel, have 3 children together. Please welcome Vitaliy Katsenelson.
All right, well, thank you very much. What a great event. Now that I'm on the podium, though, it's going to go downhill from here, so I'm sorry about that. Just as Ty, I don't wear a tie as well. One of my favorite thinkers is Nassim Taleb, and he said, why would somebody put a rope on the only part of their body where it can actually strangle you? So that's why I don't wear ties. Anyway, where's the clicker? Here it is. Well, let me tell you about myself a little bit. As you can tell from my very sophisticated accent, I was not born in this country. In fact, I was born in Russia, and I moved to the United States. Well, I'll tell you that in a second when. But I was born in Russia, and I lived most of my life in a city called Murmansk. It is located in northwest Russia, or some may call it in the north Norway. It's right there. It is a home for Russian Northern Navy fleet. Some of you may know this city from the movie of the Hunt for the Red October, where, and by the way, so you know that Red October was a fictional submarine, not real. Okay. So when I was growing up in Russia, in the Soviet Union, I hated Americans. I absolutely hated Americans. As a student in the school, we would be taken to a movie theater and see a documentary about America, and I learned three things. First of all, the blacks were lynched, this country is swarming with homeless, and everybody gets poisoned by hamburgers. Okay, of course the third part was actually true. But I truly hated Americans. If you watched not documentaries, but normal movies where there was Soviets and the Cold War movies, Americans were always nasty, heartless, mean, soulless, and greedy. I'm running out of adjectives, but you get the point. This is a true story. I think I was 9 years old. I went in St. Petersburg on a field trip, and this guy comes up to me and gives me bubble gum. He was American. My teacher runs up to me and takes away the gum and screams at me and says, "This gum is probably poisoned." Okay? I was not the only one brainwashed. Everybody around me was brainwashed. We were afraid of Americans because we thought you guys wanted to kill us. My father has two sisters. His youngest sister in 1980 moved to Siberia. So I was missing, she had two kids and my cousins, and I didn't see my cousins for 7 years. And every time I asked where my cousins are, my father would tell me, "They're in Siberia, it's too far away, that's why we never go visit them." Then in 1987, my father tells me that his sister is not really in Russia, but she actually lives in Brighton Beach. And then in 1979 and 1980, she moved not to Siberia, but to New York. And the reason my parents didn't tell me about it, because if I told my friends and authorities would find out about it, my parents could lose their jobs, so would get demoted. In fact, my father's middle sister was demoted when they found out that her sister moved to the United States. So, but the first words that came out of my mouth, and this is absolute truth, when my father told me that his sister lives in the United States, was "She's a traitor." This is the first thought that came to my brainwashed mind. Okay. A few years later, after the glasnost and perestroika came, little movie theaters started to pop up all over Russia. Imagine an apartment building, and in the basement you would have a few TVs hooked up to a VCR, and they started to show Americans movies. By the way, the funny part was every single movie was dubbed with the same voice, playing all the parts. Okay, we didn't care. Okay, we started to see Americans, from the Hollywood's perspective. The movie that probably had the biggest impact on me was the Moscow on the Hudson with Robin Williams. What we started to see that Americans are really not that much different from us. Suddenly, that propaganda that we accumulated over the years kind of washed away, and I guess you never thought that Hollywood was responsible for something good. That hate towards America went away, and a few years later, something unthinkable happened. My father's sister invited us to come to the United States. So my whole family moved from different parts of Russia to Denver. So now I have more relatives in Denver than I ever had in one city in Russia before. Let me tell you about this. All right. So I wrote two books. The first one I wrote in 2007. It's called Active Value Investing. Imagine 280 pages, 75 charts and tables. Boring book. Then Wiley came to me and said, "How about this? You take the big book, and kind of simplify it." And that's how the little book came about. And then both books were published in 7 different languages. And by the way, if you decide that you want to read my little book in Polish, now you can. All right. So let me tell you, I'm going to tell you a funny story. Okay, this is I was not gonna tell you, but I'm gonna tell you anyway. So when you write a book, a publisher expects you to go out, give talks, and promote the book. So I wrote 2 books, and after that, I've given a lot of presentations. I've given hundreds of radio interviews, a lot of TV interviews. And you know what happens? You get sick of it. Let me tell you why. Just think about it for a second. Eagles, the group, came out with the Hotel California song in 1976. And for the next, 29 years or 39 years, they sang that song at every concert, because you cannot, if you go to Eagles concert, you gotta hear that song, okay? So I kind of feel their pain, because the last 7 years, I've been talking about sideways markets, and I'm sick of it, okay? So today I'm gonna talk to you about sideways markets without mentioning sideways markets, except now, even once. So I'm gonna talk about sideways markets from a very different perspective, because I'm sick of talking about them the same way I talked about it in my book. My day job is I spend 80 or 90% of my time analyzing stocks. I'm a chief investment officer at IMA, and I basically, what we try to do, we try to build a portfolio. We try to preserve and grow our clients' wealth in this order. First, we want to preserve it, then we want to grow. But what we try to do, we try to put a portfolio of stocks that would do well over time. So I spend most of my time analyzing companies, okay? So you get a perspective from, not from top down as much, but also from a bottom up, from a guy who looks at stocks every day. So you get my temperature, how we see the stock market from a practitioner. Okay, so let's talk about this. Okay. So humans are genetically designed to look for patterns. A pattern is basically, a line is the easiest pattern to identify, because it's the shortest way to get from point A to point B. So when I talk about linearity in investing, what I'm really talking about linear thinking. Basically, assuming what happened in the past is going to happen in the future, just the same way. Okay. The problem is, so I don't have a problem with some linearities. I don't have a problem with something that is authentically linear. So when we make an assumption that it's going to happen, that's actually going to happen. Every day we wake up and we assume that the sun is going to come out tomorrow, that our relatives are going to be around. We need this in our lives. The problem I have is that things that are structurally nonlinear, but we think they're linear. And I also have a problem with things that are that look linear, but they are linear for artificial reasons. Let's talk about structural nonlinearity first. The one I want to talk about today is the price to earnings. Price to earnings lives in the domain of what I call pendulum, a place where things mean revert. Okay, so let's look at the chart. Okay, let me explain you this chart because it's very difficult to see. Okay, this is price to earnings for S&P 500 over the last 100 years. Okay, average price to earnings was about 18.7 times. That's that yellow line. What I would like you to know that there's nothing linear about this. It looks like a pendulum. Every time you think it's linear, every time it was going up, you think it's linear, it turns around and goes the other way. It surprises you, okay? So also would like you to know is this. Remember, average is about 19 times. Today we are at 30. So we are about 57% above average. Okay, that's okay. So now I want to talk a little bit about what I call, sorry, one second. Something that looks artificial linear, but actually is not linear. So this is what you see is a chart of gross domestic product for the United States, GDP. As you can see, over the last 5 years, it has grown consistently almost every quarter. So it appears that our economy is doing well because it's growing. The problem is our global economy has been steroided, okay? It was injected an enormous amount of steroids because this chart shows you what happened to the global debt, not just the United States, but this is all debt. government, corporate, financial, household debt. That debt went up from $142 trillion to $199. Over the last 7 years, it's up $57 trillion. Okay, but it gets worse. If you look at the balance sheets of central banks globally, the balance sheets went from 5.5. Central banks now own $14 trillion of debt. That's increased over 2 times over the last 7 years. Okay, so let me tell you a story. I was in Omaha a few weeks ago, and just imagine Omaha, for the Berkshire Hathaway annual meeting. Imagine 45,000 people come to Omaha for 3 days, and that city cannot handle that many people. Therefore, when you try to go to a restaurant, it's very difficult to get in. So my friend and I tried to get into different restaurants. We couldn't. So we found this Middle Eastern restaurant. It was completely empty. The guy who was the owner, he was the cook. He was the guy who was unloading boxes. He was the waiter. He was doing everything. So this place is like in the middle of nowhere. We never tried it before. My friend and I are eating there, and my friend says, "What do you think about the food?" And I said, "Well, the food right now tastes good, but the way you judge this food is not how you feel right now, how you're going to feel 2 hours from now." Okay? The way you judge our economic performance when you injected so much steroids into the economy, not how you feel right now, but how we're going to feel in the future. Okay? And this is extremely important. Why am I spending all this time talking about these linearities, talking about profit, talking about price to earnings, talking about growth? Let me tell you why. Because they are part of this very important formula that I'm going to introduce you to. I call this formula the EMC squared of stock market. Okay? Just think about this for a second. If you hold stocks, in the long run, you're going to make money for 2 reasons. Because stock prices will go up, and because you're going to collect dividends. By the way, historically, dividend accounted for about half of the return from stocks, though nobody talks about it. Okay, but what's even more important is this. Stock prices go up in the long run for really 2 reasons. This is a mathematical relationship, because either earnings are growing or because price to earnings going up. Oh, by the way, stocks go down for the same reasons as well, because earnings are declining and price to earnings are declining. Okay, so for you to understand what happened, you can use this formula to understand why stocks went up and down in the past. But more importantly, by using this formula, you can predict what stocks will do in the future as well. So if you think about stock market really is a market of stocks. Okay, so if you can apply this formula to one stock, you can apply this, then you can understand how it applies to the whole stock market. So with the next example, I'm going to try to do impossible. I'm going to try to humanize stock market through one example. I'm going to talk about a company called WD-40. Okay, and by the way, this company and I have so much in common. Okay, first of all, it was started by chemical engineer who was trying to figure out how to protect nuclear missiles from corrosion. So both this company and I are basically Cold War relics. Okay, number one. Number two, this company went public the same year I was born. This chart starts in 1999, and I promise you I'm not 16 years old. Okay, so it went public earlier than that. But what I wanted to know is this. In 1999, the WD-40 was trading at $25. Today, it's trading at $85. Okay. Over the last 16 years, this is 1999, this is 2015, its earnings per share grew about 6.5% a year. More importantly, its average price to earnings was about 18.5 times. This is price to earnings over the last 16 years. Today, this company trades at 27.4 times earnings. It is about 50% above average. Okay? Okay, let's spend a little bit of time on this chart because it's extremely important. So, in 1999, WD-40 earned $1.10. 16 years later, it earned $3.10. So its earnings grew from $1.10 to $3.10. That contributed 6.5% to price appreciation. Okay. Okay, its price to earnings 99 was 18.5 times. 16 years later, it's 27 times. This increase contributed another 2.5%. So you add this together, and you get 6.5, 2.5, and excluding rounding, you get about 9%. You add about 1.7% you received in dividends, so you made 10.6% if you bought WD-40 in 2015. So by looking at this, for you to receive the same, what has to happen for you to receive the same return, let's say over the next 7 years, okay? So let's take a look. So the earnings have to go from $3.10 to, and this is from 2015 to 2022. Earnings have to go from $3.10 to $4.80. So they have to grow 6.5% a year. What's more interesting is this. Price to earnings has to go up from 27.4 times to 33 times. Remember, today they're trading at already 50% above average. So they have to start, the WD-40 stock has to trade at 75% above average for you to continue to make the same amount of money that you made in the past. Oh, I'm sorry. Okay, so the stock price, did I screwed up, right? No. Yeah, okay. So therefore, the stock price would go from $85 to $157 if all these things happen. Ty, and he asked me to attribute it to him, he called it linear hope scenario. Okay, so let's look another, what I call an optimistic scenario, okay, which is a lot more realistic than the one before. Earnings grow at 6% a year, but price to earnings declines from 27 times to 19. Do you remember the chart of price to earnings, historically? Okay, so what I'm saying is this. Price to earnings would decline from above average, and it stops at average. Okay, the reason I'm calling it optimistic, because it's not going to go through the average like a pendulum would. It basically stops at the average. So you would make 6% a year from earnings growth. You would lose 5.5% a year because price earnings declines. So basically, the stock would go nowhere for the next 7 years. Okay, you would collect 1.7% of dividends, so you would make roughly about 2.2% a year over the next 7 years. Okay. Again, the reason I'm calling it optimistic because it's basically stopped. The price to earnings goes from above average, and usually when valuations are very, very high and they decline, they overshoot the average significantly. Okay, I'm sorry. Okay, so now this is what I call a likely scenario. Okay, remember, we live in a world that has been steroided by so a lot of the growth in the past came because we borrowed a lot of money. Okay, so it's reasonable to expect that WD-40's earnings growth going forward is going to be lower than it was in the past. The same way our economic growth going forward would be lower than it was in the past. So therefore, in this scenario, I'm saying earnings will grow, which is still an assumption, at 3% a year, but price to earnings declines from 27 times to 16. Now it's about 3 points below average. Suddenly, the stock goes up from $85 to $61 because all the benefits you get from earnings growth is wiped out by price to earnings compression. Okay, so therefore you end up losing money in the stock, a significant amount of money over long term. Okay. Oh, by the way, another way to, actually there was even an easier way for me to explain why you would lose money on a WD-40. The market value of the company today is $1.2 billion. So if you and I put our money together, we could buy the whole company for only $1.2 billion. Okay, its earnings today are $44 million. So you're paying $1.2 billion for only $44 million of earnings. That's why you're very unlikely to make money owning WD-40. So now let's compare WD-40 to stock market. Okay, this is where it gets interesting. So WD-40 trades at 27 times earnings, S&P 500 at 30 times earnings. Average PE for WD-40 is 18.5. Average PE for S&P is 18.7. So WD-40 trades 50% above average. S&P trades at 57% above average. Future returns for both stocks are extremely exciting. Actually, there was one point I forgot to make, which is kind of very important. Why do price to earnings behave in a pendulum-like manner. Why do they do this? Why does it happen? And it's really because people are emotional. There is no surprise there. We have periods of greed when price earnings are low and stock go up. And as stocks go up, people start buying more and more stocks, and they drive valuations to very high levels because of envy. Okay, and then when stocks start to decline, people start to panic, and they drive price to earnings to below average level. So this is why you have this pendulum-like swings. I'm going to talk about my firm's strategy for today's environment, but I'm going to try to simplify it a little bit just because we don't have enough time. So I'm going to start by quoting one of my favorite thinkers, is Charlie Munger, who said, "Tell me where I'm going to die, that is so I don't go there." So our strategy is figure out what can kill our stocks in our portfolio, and then adjust our stock selection so they don't die. Okay? So the first thing you do is you don't buy WD-40s. Okay? You don't buy stocks that are so expensive. You don't buy stocks that became basically bond substitutes, because people are buying them because they cannot get a 5% return from treasuries. Okay? Another thing you want to do is you want to demand a higher margin of safety from stocks you own. We want to demand a higher margin of safety from stocks we own. Let me just explain what margin of safety is. We're trying to buy $1 for less. If you buy $1 for 70 cents, you have a 30% margin of safety. Okay? What I'm saying is, instead of paying $1.50 for $1, and that's exactly what happens when you buy WD-40 or stock market as a whole today, you want to increase your demand for margin of safety. Instead of buying $1 for 70 cents, you want to buy $1 even for less, which makes your ability to find stocks into this environment a lot more difficult. Another thing you want to do, you want to look for stocks whose revenues march to a different drummer than GDP. We want to find companies that are not cyclical, whose earnings growth would be there no matter what happens in the economy. It's very difficult to find them, but you want to own those. You want to own a portfolio of stocks that you cannot kill. I basically call them cockroaches. And by the way, be very thankful that I did not put a picture of a cockroach. Okay, but I call them cockroaches or Twinkies. Okay, because think about it. If you have God forbid, if you have a nuclear event, the only thing that is going to survive is a cockroach. Okay, so if you want to own stocks that can survive no matter what you throw at them. But here's an important point. I think this is the point Ty was trying to make. If you cannot find a portfolio of stocks, you should have cash. The way I look at it, cash should not be a market timing decision. Cash should be a byproduct of your stock selection process. If you cannot find stocks that you cannot kill, that are cheap, that are high quality, then you should not force yourself into buying WD-40s. You should have more cash. Okay, what's going to happen in the future? Deflation and inflation. Here's what's interesting. If we have inflation, then companies that have a lot of debt will actually benefit. However, if you have deflation, companies that have very little, have a lot of debt will get killed. So the way we look at it, we try and avoid death. Therefore, we'd err on the side of companies that have very little debt. Okay, my favorite quote by Charlie Munger, if you're not confused about global economy today, you don't understand it. Okay, so instead of trying to be a weatherman, I encourage you to become a climatologist, and that's what we're trying to do. Think about a weatherman. Weatherman is trying to predict what the weather is going to be next week. Okay, it takes a lot of energy, and you're not going to get always the forecast right. But more importantly, that forecast has a very short shelf life. 2 weeks from now, it's going to be irrelevant. However, as a climatologist, you want to identify big changing events, and you want to focus on them. So in other words, instead of trying to figure out what the job number is going to be, if the Fed is going to raise interest rate next month or 6 months from now, if instead of trying to focus on these things that are really noise in the short, even in the long run, you want to focus on what are the risks to our portfolio in the future. Okay, so it would be high inflation, deflation, high interest rates, Japanese bubble, that bubble blowing up, Chinese economy blowing up because they have overcapacity bubble. So those are things you want to focus on and try to adjust your portfolio accordingly. Another thing is this: you basically want to say 3 most difficult words in my profession. I don't know. If Ty called this event the I don't know symposium, nobody would show up, right? Because in our profession, we expected to know. So you will never see a person at CNBC say, I don't have an answer to this question because I don't know, okay? But in reality is this: never before we had an economy, global economy, and every single major economy that's been as levered as it is today, where this central bank's balance sheet were as levered, and where the interest rates were that low, artificially low. Okay. Therefore, we have no idea. We have no playbook to look back and say, when this happened, this would happen next, because it never happened before. Therefore, we have no idea what the future holds. Okay. Admitting to yourself that I don't know will allow you to create this what I call I don't know portfolio, a portfolio that will survive no matter what is thrown at it. Okay. And here's my point. If you're a poker player, you know that the worst thing that could ever happen to you is to have a second best hand. What is the second best hand? It's when you have a very good hand and you think you're going to win. So if you think you're going to win, you're going to bet aggressively, right? Okay? And what's going to happen is this: your opponent may have just a slightly better hand, okay? And you're going to lose a lot. Just think about it. If you had a mediocre hand, you probably would not be as aggressive unless you were bluffing, right? So you probably would not lose that much. So the worst that can happen to you today is that you are convinced that we're going to have inflation, okay? So what do you do if you're convinced that you have inflation? You're going to buy a lot of gold, okay? And or you may be convinced that you have deflation. If you think you're going to have deflation, you're going to buy 30-year treasury bonds, okay? So, but here's the problem: is that if you're right, you're going to make a lot of money. So that's not the problem. The problem is this: if you're wrong, you're going to lose a lot. Okay. So what I encourage you is to have this strong beliefs loosely held in this environment. Time for strong opinions loosely held. Here's my final point. 2 of my favorite quotes are: the first one is by Milton Berle. I used to be bullish, then I was bearish, and now I'm brokish. The second quote is by Anonymous, and this is really my favorite. Dear optimist, pessimist, and realist, while you were busy arguing about the glass of water, I drank it. Sincerely, opportunist. Okay? So why am I, there's really 2 of my favorite quotes, and I couldn't understand what I like so much about them. So then I decided to create my own quote. So here's my immodest self-attribution. So what I realized, we are in an environment where you don't want to be dogmatic. You want to be opportunistic. When you look at the world today, you want to be don't know-ish. You want to opportunistically look for values, one stock at a time, and stress test companies for high growth rates, profit margins, valuations, and uncertainty of today's world. And let me add one more thing to this. If you cannot find stocks that meet your criteria, it's better to do nothing. I call holding cash or short-term bonds doing nothing. So thank you very much, and Ty, tell me what to do. Thank you.
Okay, so since we probably have still about an hour left, let's take a break, stretch it out. No. Okay, so I just want to thank everybody for coming to this event. Without you, we wouldn't have been able to put it on, and without you, we wouldn't have jobs. So round of applause. Okay, the next thing I need you to do, do you still have this white envelope that had your drink cards in it and everything? I need everyone to pull out this little blue slip and wave it in the air. Just like this. All right, to the right, to the left. Okay, what's on this sheet is just a little survey over Ty's presentation, Vitaly's presentation, your overall experience that you've had here. So if you could just fill this out, and you can give it to one of the ladies that helped you in the beginning, and we just want your feedback, okay? Another thing, we have all these beautiful cupcakes left, and we don't need them. Just like the chocolate you see in HFG, we don't need it. Come take it, okay? So cupcakes are over there in the corner. If you get the blue ones, you're gonna have a great smile, okay? So have a great night, and thanks for coming.